I will walk you through the functionality of valuation application. This one covers APV, adjusted present value, beta, capital asset pricing model CAPM, cost of capital, weighted average cost of capital WACC, and WACC valuation. APV, let's say the free cash flow is 500, we add that. Free cash flow is 700, we add that. Free cash flow is 800, we add that. And free cash flow is 900, we add that. And free cash flow is 1000, and we add that. Then what we can do is we can specify the asset cost RA and say PVTS, present value of tax sale, say 1000, present value of financial distress is 700, and now let's calculate APV, and this is what becomes the APV. What we can also do is we can specify what time a cash flow is occurring and how many times the cash flow is repeating. Say 1000, we added that. Say now 200, the cash flow time is 3, it starts in the third year and is repeats twice. We can also do that. So this is a way to accommodate if a cash flow is repeating multiple times, and we can also specify exactly what time the cash flow is occurring. So now I will move into beta. In beta, there are two things that happens in beta. One is on-levering beta, second is relevering beta. In on-levering beta, what we are doing is we are going to on-lever the asset beta, and in a relevering beta, we are going to apply the asset beta, unlevered asset beta, and the leverage to come up with the leverage equity beta. So let us say that the equity beta is 0.5 and the debt beta is equity beta is 0.5, debt beta is 0.3, tax rate is 35%. If you want to change, you could always change it. We can specify debt and equity or leverage. It's one of the same thing. Say I'm going to specify leverage, say it is 80% leverage. So now this becomes the asset beta. So now we can actually add multiple asset betas, and say we are looking at another firm, and then that is our asset beta. And then we can also say another firm, say we are adding is 7. So this is what it becomes. So this is the average asset beta. So we are going to re-leverage. So either we can specify the debt and equity or leverage. So debt is 70, equity is 30, and then we are going to supply debt beta. So debt beta is 0.7, and then if we re-lever, this is what becomes the new equity beta. So CAPM, this is the capital asset pricing model. So risk-free rate is 0.292, beta is 0.7, market risk premium 7.2 percentage, and then this is what becomes the equity, cost of equity. Cost of capital, so we specify the risk-free rate 0.292, beta is 0.7, market risk premium 7.2, and then we can actually specify the cost of debt, say 0.8, tax rate is 0.35, and then we can say leverage is 0.8, 80%. So then that becomes the cost of capital. We can also specify the cost of equity and cost of debt. So we can also specify debt 70 and equity 30, and we don't have to specify leverage, it's going to calculate, and this is a new way to come up with the cost of capital. Let's take a look at the WACC valuation. So we specify horizon period 5 years, interest rate is 7%, and risk free, so we're going to add free cash flows. So we are at free cash flow, then 300, second year, third year, fourth year, and say fifth year is terminal value, say 3000, date is 2000, and then cash say 1000. Then the WACC is, this is the WACC. Enterprise value, present value of cash flow, present value of terminal value, and net debt. With this, I pretty much covered the valuation. We went over APV, beta, CAPM, WACC valuation. Thank you very much.